Good morning, everyone. We're waiting on people to arrive, so give us just a moment. Okay, folks, we're going to get started. Good morning, everybody. My name is Josh Stripmatter. I'd like to welcome you to Stripmatter Wealth Smart Money webinar series. Thank you for joining us today. For those of you that don't know us, we are Stripmatter Wealth Management Group, a registered investment advisor located in downtown Fort Worth, Texas. We specialize in investment management, financial planning, estate planning, and real estate investing. We've been in business since 2007 and served clients throughout the United States. Our presentation today is titled Social Security, 7 Keys to Enhancing Benefits, and will be presented by Aimee Johnson. A little bit of housekeeping before we get started. All of you have access to the chat feature, so if you have any questions, please don't hesitate to type those in. We're happy to answer those questions for you. Also, we'll be sending out a replay of today's presentation, so if you missed something, please don't panic. You'll get the replay. And you're welcome to forward these presentations to your friends and family if you'd like. And there's also a library of former webinars on our website, stripmatterwealth.com. Today's webinar is meant to be purely educational and is not meant as tax or legal advice. Please talk to your licensed professional before taking any action on any of the information in this presentation. For key information, including clean disclosures, please visit our website at stripmatterwealth.com. And if you have questions today, Aimee will be answering those for you at the end of the presentation. So just type those into the chat feature and she's happy to answer those questions for you. Again, if you'd like to go to our stripmatterwealth.com website, there's additional information that you can find, including e-newsletters that you can sign up for. And then listen to us on our radio show called Ask the Experts every Saturday at 10 a.m. on 1190 a.m., where we answer your financial questions. And with that, Aimee, let me introduce you. So Aimee is a VP of Advanced Markets and Solutions, and she is responsible for speaking to clients and financial professionals about ways to effectively accumulate, protect, and distribute wealth. Aimee brings 21 years of industry experience as a speaker at national and regional events throughout the country. So that being said, thank you very much, Aimee, for being here today. I'm going to turn this over to you, and give me 1 second to give you the screen here. And there you go.
Josh, thank you. And thanks everyone for joining us. Today, we're going to talk about a lot of interesting stuff when it comes to Social Security. It seems like that decision could be somewhat cut and dried, but I got to be honest, for a lot of people, it's not necessarily a cut and dried decision. So today, what I'd like to do is share some information that you might find insightful, since Social Security is really the foundation of retirement planning. So I'm going to pause briefly on this disclosure as well, just to give you an opportunity to take a look at that. So as I mentioned, a lot of people think that Social Security is cut and dried, but it is really a source of income that we do have some control over. And that's really why I think it's so important that you joined us today, to really give you the opportunity to learn a little bit more about Social Security and where you can control the various aspects of that. So let's start by talking about benefit basics. We'll talk about how benefits are calculated, when to actually start benefits, what happens when you work and collect Social Security prior to your full retirement age. We'll talk about taxes, and we'll talk about spousal and survivor benefits. We'll skip Medicare at the end in the interest of time. So let's start by talking about benefit basics. Well, as of June of 2020, about 65 million Americans are collecting Social Security, and it pays out about $1 trillion in benefits. One of the things that I would point out about Social Security in particular is there's really 3 buckets of benefits. There's survivor benefits, benefits for disabled individuals, and benefits for those who are retired. I just want you to know that each of those buckets of benefits, those types of benefits, come with their own set of rules. So if I say something to be true, especially say for survivor benefits, it's not probably going to be true for retirement benefits, for example. So just something to keep in mind is when it comes to Social Security and what the rules are, the devil is in the details. So one of the elephants oftentimes when we talk about Social Security is just, will Social Security be there for the long run? Of course, we've seen in the media that the Social Security Trust Fund reports that it will be depleted by 2034. So let me explain specifically what that means, because when we hear the word depleted, what does that mean to us? Probably zero, right? That there's nothing there, and that's actually not the case. So just like a pension, the Social Security Trust Fund has to report the viability of the payments into the future. And as of 2034, Social Security will only have enough incoming revenue to pay about 76% of outgoing benefits. So once they fall below that certain threshold, it's considered to be depleted. So that's where that's coming from. So it doesn't mean zero, it just means obviously not enough revenue. So something does have to give, there's no doubt about that. So one would say that there are a number of things that could come about. Perhaps it's legislative change that would impact the amount of taxes that we pay as workers or across the board. It could also mean, say, for example, that we have to wait a little while longer to collect benefits. So maybe the age for early Social Security enrollment would go from 62 to 63, or any number of things can happen. But I think we can probably all agree, despite the fact that there may be legislative change that would impact our benefits, they're not going to go away completely. But I think we should be prepared perhaps to pay more taxes along the way, or to see some adjustments to help the viability. Because at this point in 2034, there will actually be more people working than there are more people collecting Social Security than there are working. So that's a pretty big adjustment, isn't it? And certainly something to consider is that it's just that more and more baby boomers are retiring, and it's putting some stress on the system. So let's talk a little bit about how you might actually see what your benefits are currently. Make sure that we get some real facts into your hands. So if you go onto the Social Security website, ssa.gov, and here we actually put in the real URL. I think the biggest thing with this is just knowing that this is the right website, so that when you're entering your facts and your information, you know that this is the right website, that you're not entering that into a website that might be a bad one. So they will ask a number of questions, of course, your name, your date of birth, your Social Security number, those types of things. They'll also ask some questions based on your credit report to verify your identity. So when I did mine, I answered multiple choice questions, like at what previous address did you have a mortgage? Who do you currently have your mortgage through? Who's your car loan through? Those types of questions. Once you answer those questions, you get a copy of your Social Security statement, or access to that. It looks just like the statement that you've received all of your working years prior to this. I'd say it was a number of years ago that Social Security started sending out statements or stopped sending out statements as a cost saving measure. So definitely a great way to get access to the most current information for yourself, and to verify that any past earnings were reported on your behalf correctly. So now let's move to how your benefits are calculated, how you actually become eligible for benefits. So to be fully insured, we have to earn 40 credits. Most of us earned those 40 credits through 10 years of work. Those 10 years of work then allow us to become eligible. Nowadays, it's a little bit different. We noticed, or of course our lawmakers noticed, that we were discriminating against seasonal workers who may not work year-round, but may have fairly substantial earnings in the period of time that they're working. So as a result, now you earn 1 credit for every $1,470 that you earn. So once you've earned $5,880, you've earned your 4 credits for the year. So for many of us, if we've already earned $5,880, even though we're only in July, we've likely earned all 4 credits for the year. So for someone who may be falling a little short, it may be possible to take on a job and have some earnings and probably not even have to work a full year if, say, you're only a few credits short. So how are your benefits calculated? Well, the first thing to know is your benefits are based on your primary insurance amount. Your primary insurance amount is the amount that you collect at your full retirement age. For everybody, your full retirement age is going to be a different age. Or I shouldn't say for everybody, it's going to be a different age. It's based on your date of birth. So say for myself, my full retirement age is 67, where for some individuals, it might be 66 in a number of months. So it's anywhere from 66 to 67, again, depending upon your date of birth. So a couple things to note about this is that your primary insurance amount is based on your average index monthly earnings. Basically, what Social Security does is they take all your earnings, they index those to today's dollars, and they take your 35 highest earning years, your 35 highest. So not your most recent. So even if, say, you started working part-time as you ease into retirement, that wouldn't necessarily impact your benefits. It could impact your average if you don't have 35 earning years. But something to keep in mind there, your 35 highest earning years indexed to today's dollars. If you don't have 35 years, they put zeros in place at those years. So that would bring your average down. So ultimately then what we're looking at is making sure that we have as much earnings as possible in a 35-year period. They index those to today's dollars, and they basically take an average of those and apply a calculation. If you start collecting your Social Security benefits prior to your full retirement age, so like I said, for myself at 67, then my benefits are reduced. If you wait beyond your full retirement age, up to age 70, there's no reason to postpone beyond age 70, up to age 70, your benefits actually get what's called delayed retirement credits. You get 8% per year plus cost of living adjustments. So now let's talk about when to start benefits. So a lot of people start asking, well, when's the best time for me to take benefits? And we'll get into kind of the art and science of that here in a minute. But as I shared before, for someone who chooses to take their benefits early, there is a reduction. So say your full retirement age is age 66, and you start at age 62, you'd see a 25% reduction in your benefits. For someone like myself, currently the way the rules are structured is that if my full retirement age is age 67, my benefits are reduced by 30%. So a little bit about the art and science then of this in particular. So here's the thing. Most people will say, well, Aimee, just tell me when I should start collecting my Social Security benefits. But there's a little bit more to it than that. Ultimately, I just need one little bit of information, as does Josh, and we could tell you exactly when to start your benefits. We just need to know when you're going to die. And then it's just a matter of math. But since none of us know that, we don't have a crystal ball, it becomes a little more challenging to determine when you might need to start collecting benefits. So why don't I walk you through this a bit to give you a sense of, oops, I hit the wrong button there. Give me just a sec here to pull this back up. There we go.
Happens to the best of us, Aimee.
Oh my goodness, I tell you what. And then I have construction going on in my front yard, and they've decided to become extremely loud. So I'm so sorry if there's a little bit of banging and beep beeping. So let's talk a little bit again about the calculation of benefits. So say you have a lesser than average life expectancy. I've had a number of people say, I have kidney disease or some sort of other disease that may impact your longevity. So say, for example, you're an individual that has a full retirement age of 67 and a benefit amount of $2,000 a month. Simply using math with no cost of living adjustment, no discounting, we would take that benefit then and say that individual, you as that individual starts at age 62 and you live to age 70, you would collect the $134,400. Now, of course, if you waited longer, till say age 68, you would collect that much less money. So if you have lesser than average life expectancy, it absolutely benefits you to start your benefits early. But you might be asking, well, Aimee, Josh, what is average life expectancy? So once you reach age 65, average life expectancy is about age 85. And that's from a gender neutral standpoint. Women live a little while longer typically. And you can see that there's little difference between the benefit amounts really when push comes to shove from 62 to 70. So frankly, I have to be honest, I'm a pretty big supporter of just waiting until your full retirement age because I think it plays well into the law of averages, of course. But say you're an individual who may have a longer than average life expectancy, say age 90, you eat well, you exercise, everyone in your family lives a good, long, healthy life. In this example, then if you say may live until age 90 and you started at age 62, you'd collect $70,400. But if you live to age 68, you'd collect about $100,000 more. I'm sorry, if you started at age 68 and lived until age 90, you'd collect about $100,000 more. That's a pretty big difference. And where I really see this difference coming into play is if you want to try to get as much money out of Social Security as possible. It's something that you've paid into your whole life and you want to roll the dice on your longevity and bet that you'll have more money. Say, for example, you feel like you sit down with Josh, you might have a little bit of a retirement income shortfall, and that $100,000 in the long run would make a big difference. You could work a little while longer, collect a little later, get a bigger benefit. For some people, that makes all the difference in the world for their retirement income when they do choose to retire. But if you're not in that school of thought, you're not alone. I can't tell you how many people that I've talked to that have said, I just want to get while the getting's good. This math and science of this doesn't matter. I'll put whatever I can get in my pocket now because I don't know what the future holds. You are certainly not alone in that thinking. And you're certainly, as long as, in my opinion, as long as you feel like you have the retirement income that you're looking for, it's really ultimately your decision. But I love giving people the information so that you can make an informed decision. So along that same line, let's talk about what happens if you work and collect Social Security. So yes, you can indeed potentially work and collect Social Security, but let's talk about what that means specifically. So in 2021, so this year, if you are age 62 and you choose to start collecting benefits while you're working, your benefits are reduced by $1 for every $2 you earn above $18,960. So for an individual that's eligible for an average benefit, once you earn about $40,000, you've earned too much money to work and collect Social Security. So for most people, prior to your full retirement age, you're not actually eligible to collect Social Security and work at the same time, again, prior to your full retirement age. So in the year in which you turn your full retirement age until the month in which you turn your full retirement age, your benefits are reduced by $2 for every $3 you earn above $50,520. But here's the real, probably moral of the story here, if you will. Once you turn your full retirement age, you can work and earn all you want, and there's no reduction in your benefits. So what's really cool about this is that my dad actually did this. He turned his full retirement age. He was going to retire and start Social Security, but he realized he could double dip, if you will. He could collect Social Security and work. And he collected 2 paychecks for a while, and that gave him the ability to buy a new car and really go into retirement more financially stable than he may have otherwise. So pretty cool, but just remember that if you're working and collecting Social Security prior to your full retirement age, it could reduce or completely eliminate your benefits. This applies to individuals who are collecting retirement benefits, as well as widow or widowers that are collecting survivor benefits. So let's just look at an example of this. We have Susan. She was born in 1959, and her Social Security benefit is $18,168. Because she's collecting early, she's going to see a reduction in her benefits, so she's only going to get $12,863. She's reporting her current earnings of $40,000 to Social Security. Don't keep it a secret; they'll find out later, and may reduce your benefits later when you're not working. So not cool to not tell them. Believe me, you want to tell them. And then the earnings limit for this year is then $18,960, as we had mentioned before. So her benefits are reduced by $1 for every $2 she earns above that $18,960. So she earns $21,040 above that earnings limit. So we took the 40,000, subtracted the 18,960 to come up with the $21,040. We take that 2140 and divide it by half, because her benefits are reduced by $1 for every $2 she earns above this threshold. So we take that 10,520 and we subtract it from her benefits that she's eligible for, and we come up with $2,343. And please let me be clear, that's $2,343 for the entire year. And it's income taxable. Is it worth it? I'd venture to say no. If Susan's working, she is probably way better off continuing to postpone or delay her benefits, make sure that she doesn't take such a huge cut in her benefits for taking them early, and just take her benefits later. So again, in my opinion, better to wait a little while longer, closer to your full retirement age. There's much less reduction in your benefits, of course, the closer to your retirement age or your full retirement age that you retire. Let's talk about how your benefits are taxed. So your benefits are taxed based on your combined income. Your combined income is the sum of your adjusted gross income. So that's all of your income. That's your earned income, your investment income. The only income that doesn't really fall into this category, say, is Roth income or reimbursements for qualified medical expenses from your HSA or something along those lines. Plus any non-taxable interest, plus half of your Social Security equals your combined income. So you have to have a fairly low income to see none of your Social Security benefits be income taxable. So if you're single or head of households, your combined income must fall below $25,000 or $32,000 married filing jointly in order for none of your Social Security benefits to be income taxable. If your combined income falls between $25,000 and $34,000 or $32,000 and $44,000, then up to 50% of your Social Security benefits are income taxable. If you exceed the $34,000 single or $44,000 married filing jointly, up to 85% of your Social Security benefits are income taxable. So I want to clarify one thing. So here we're talking about any type of income. When we were talking about benefits being reduced, that is based on earned income. So if you're collecting what we would consider passive income, like a pension or investment income and those types of things, that's not going to reduce your Social Security benefits. The only time you're going to see your Social Security benefits reduced is when you're working and earning an income. So not passive income, but active income from work. So I oftentimes get that question. There can sometimes be confusion. Just know that that reduction that we talked about in the previous section was purely based on working and collecting Social Security, not collecting investment income in Social Security. Now let's talk about spousal and survivor benefits. So if, say for example, I was a homemaker most of my life and I'm not eligible for a Social Security benefit, or my benefit is just much less than my husband's, I may be eligible for a spousal benefit. So what happens with the spousal benefit is that I would ultimately be eligible for half of my husband's primary insurance amount. That's the amount that he would be collecting at his full retirement age. So say my benefit is $750. So, and his is $2,000. Well, half of his, or the $2,000, or half of the $2,000 or $1,000 is certainly going to be greater than my $750. So I can absolutely take this half of his $2,000 based on my age. So one of the things that you have to know or understand about this particular benefit, though, is my husband has to actually be collecting his own Social Security benefits. So once he's collecting his own benefits, again, I'm eligible for half of his, adjusted for the age that I take it. So say I start early, of course, then what happens? My benefit is reduced. The other option is say I was eligible for that $750, say I'm age eligible, so I'm age 62 or older, I could start my own benefit, but let's say I'm my full retirement age. So let's say I'm 66. I start that $750. When my husband later retires and starts collecting his own Social Security benefits, then I'm eligible for a $250 increase. Again, based on the age that I take it, but up to that $1,000 or half of his benefit, again, adjusted for the age that I take it. So if I take it early, my benefit goes down. So I covered that. We're going to skip this because it's an option that many people aren't eligible for anymore. And we'll go right into talking about survivor benefits. So with survivor benefits, we're eligible to collect benefits as early as age 60. So we can start benefits anytime between 60 and our full retirement age, or even later if we want to earn those delayed retirement credits. Do remember that that earnings test does apply to widower benefits. So if I'm age 60 and I'm still working, I may earn too much to qualify for a survivor benefit. There are some special allowances within survivor benefits, one of which is say I could start my own benefit, post taking my husband's benefit, and later switch to his if it's bigger. So they do allow some interesting changes within survivor benefits that wouldn't necessarily be something that we would be eligible for under the retirement benefit. So some allowances here, a good thing to really look at. And if you do take survivor benefits early, they are reduced, but not nearly as much as the retirement benefit reduction if you take benefits early. Now let's talk a little bit about divorce benefits. If you are divorced and not currently married, you could be eligible to collect benefits based on your ex-spouse's earnings history. But there's some rules that apply here. One of which is that the marriage had to have lasted for more than 10 years. And then, frankly, you both have to be age 62 or older and you cannot currently be married. So if you want to collect based on your ex's earnings history, you cannot currently be married. If you're married, you're going to collect based on your current spouse's, or of course your own, whichever is greater. But it works a lot like the spousal benefit that we talked about before. So you would get your own benefit, or half of your ex's, remember it's or half of your ex's, again, based or changed or reduced if you take it early. So it's based on the age that you take it. So sometimes people will ask, well, what if I have more than one ex-spouse? Who do I collect off of? Well, the one that made the most money. What if I'm remarried? Can my ex-spouse collect off of me and my current spouse? Yes. Will it reduce that individual's benefit? No, it will not. So there's a lot of opportunity then to really, look at who you were married to in the past and determine maybe which scenario would be the best for you. So one extra little tidbit of information for you, say you were married to two individuals previously, one is still living and one is deceased. If you have a deceased ex-spouse, survivor benefits kick in, and you would actually be eligible for 100% of their benefit, not just half. So definitely work with Social Security, give them the information based on the individuals that you were previously married to, and they can give you some insight into how much you would be eligible for based on those circumstances. So definitely something to keep in mind. If another little caveat that I should mention is if you're married to that individual, you actually have to wait for them to start collecting. Remember, I brought up that rule. So if you're married to that individual, you want to collect a spousal benefit, you have to wait for them to start their benefit. But for divorced individuals, that rule does not exist. So as long as you were divorced for at least 2 years and you're both age eligible, age 62 or older, you can collect based on that person's working history, even if they have not retired. So I'm going to skip through the Medicare because that can be a lengthy discussion as well. And I'll just summarize the fact that we talked about some basics, how benefits work, how they're calculated, when it's most advantageous to start benefits. Again, a lot of that has to do with how you feel about it, and then ultimately whether or not you want to maybe roll the dice a little bit on your own life expectancy. We talked about what happens when you work and collect Social Security, how your benefits are taxed, and we also talked briefly about how spousal and survivor benefits work. So with that, I want to pause for a moment and just give you an opportunity to enter any questions that you might have in the chat. And I'll close out by saying, what are some things that you can do? Well, I think it's just important to understand your various options so that you can make an educated decision. And if you choose to enhance your Social Security benefits by, say, potentially waiting or looking at some other opportunities, that is certainly something that I would encourage you to do. But I think the biggest thing is just making sure that your retirement needs are covered by sufficient retirement income sources. And consider things like annuities if you find that you might have a retirement income shortfall. If you find that, oh, maybe I don't have enough stable, dependable, reliable income to cover my expenses, annuities can be a great source of stable, dependable, reliable income throughout your life. But definitely meet with Josh at Wealth Management, and get a sense of where you're at, how prepared you are, and he can certainly discuss potential solutions for your specific situation. So with that, again, I'll pause and give you an opportunity to enter any questions that you might have in the chat. Josh and I would be happy to answer the questions that you have.
Aimee, thank you so much. That was great. And I always learn quite a bit when I have these presentations. And today it was some great information. And so I'm sure that your presentation provided a lot of great information to our viewers. So thank you so much. So folks, if you have any questions, now's the time to type them into your chat box there. And Aimee will be happy to answer those for you. It's interesting. I've been presenting on Social Security for many years now, and a long time ago, I read a book, and that's kind of what my presentation was built on. And your presentation actually follows my presentation almost to the T. So it's interesting how your methodology is laid out here. But you know, there's a lot of neat things about Social Security that people aren't aware of, and that they should really be taken advantage of. And so it takes having that body of knowledge to do that, though. So Aimee, I don't see a lot of people typing in questions here, folks. So folks, we'll wait just a couple more minutes. Oh, here's one. This is from Gary Newman. It says, how is your maximum family benefit calculated?
Okay, so ultimately it's based on what your family maximum would be, and that's actually on your Social Security statement. So basically you can look directly at your Social Security statement to determine what your family maximum would be. Then say, for example, it's, you know, your spouse and your 2 children. If you're all eligible for a benefit, then basically what happens is they take those 3 individuals and say your family maximum is $1,500, then the most that any of those 3 individuals would get would be $500 a piece. Now that's a fairly low amount. You know, if you're an average earner, it's absolutely going to be more than that, but I just use lower numbers for the simplicity of the math. But that's ultimately how it is. So you refer to your statement, and then the number of individuals who are eligible to collect based on your earnings history, then it would ultimately be divided by those individuals. Do keep in mind that your any spouse that you are divorced from, so any exes, do not come into that family maximum equation. So kind of an interesting little tidbit. I hope that helps.
Absolutely. All right, folks, any other questions? Well, for future webinars, please go to stripmatterwealth.com and you'll see our catalog, or our calendar rather, for future webinars. Aimee, thank you so much for your time today. We greatly appreciate it. Hope to have you back real soon. All right, folks, thank you very much. Have a good rest of your week. We'll see you next time.